People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. My name is Randy Cook, and each week, Charisse and I sit down here and talk through some of the things you might be wondering about or worried about or just kind of curious about when it comes to getting into this thing called retirement. Maybe you're already there, and you're finding, okay, I'm getting adjusted to this, and now I have more questions. Okay, that's why we're here. Charisse, how are you doing today?
I am doing fantastic. We had a fabulous Galentine's event for our clients here at the Ivy House. It was so delicious. We played amazing games and no men were allowed. Sorry, guys. And then we had a fun Valentine's party at Zinnia. I wake up at like 6 o'clock in the morning to rush to Publix to get flowers and chocolates and all this stuff. And one of my girlfriends, Tyla, from Healthy Hub, she made these cute little charcuterie boxes. So every year I do something pretty big like that. But for some reason this year, the team was like, this is next level. And I'm like, this is the same as I did last year. But anyways, they were happy. So we want to make sure the ladies and gents of Team Zinnia are happy and feeling a little loved on the Valentine's weekend that just passed.
So I didn't go crazy on Valentine's Day this year, but I did see something that I wanted to get because we have cats in the house and cats and flowers don't go well together. So they have these cards that you can buy that when you open them up, it like becomes this bouquet of paper flowers, right?
So
I thought,
how big is it? Is it big or like a little card?
It's a pretty big card,
Okay.
And so I thought that looks pretty good. So it was $20. So I ordered that, right? And it didn't come. And it didn't come, and it didn't come. And then I get this email, and it says, it's on the way. And I was like, okay, great. It's coming from Italy.
Oh, yes.
Oh, no. Yeah. And now I'm probably going to get tariffed and everything else. I don't know. But, yeah, it never got there.
It'll be a day late.
Yeah, we're still waiting on that one. All right. Well, you might be waiting on Dow 50,000, and we finally hit Dow 50,000.
I know.
Charisse, for years, I mean, people wrote books about this. They wore hats that said Dow 50,000, and then we got there, and I figured that confetti would fall from the sky, and it didn't. It was just another day in the stock market. Back and forth we go. Yeah. But since you and I have last talked, there's been some crazy stuff that has happened. We've got Dow 50,000 back and forth. Bitcoin has been cut in half.
What the heck?
Down 50%. And gold went way up, and then in one day went way down, and then started back up again.
I know.
So
it's amazing.
Let's talk a little bit about this. First of all, when we hit these big numbers, Dow 50,000, I don't know that it means as much as it used to anymore because, if the market goes down 500 points, it's only 1%. Nobody cares anymore. What do you see?
When I go back 20 years, when I was driving to my clients' houses, they would have the news on. They're like, look, the Dow hit, da-da-da. Yeah. And I'm like, yeah, I mean, it was like a big deal. And I remember 10 years ago, it would be a really big deal. And now it's like, is this another day in paradise?
I know.
It's like, we're just going to keep going because everything's just been going up. And the more money invested in the market and the more it grows, the higher the numbers. And, Wall Street gets excited about it. But I don't think people care anymore, understand it. They're just happy to be making money. And it's such a big number to wrap your mind around. It's like, okay, what does that mean? Because now when you lose 10%, it actually means something a little bit different to people than I think it used to. I think back in the day, it used to be like daunting, like, oh, we lost 10%. And now these quick little corrections, when you lose 10%, they're like, oh, it'll come back up. I feel like people are so trained. And when you lose like 2,000 points in the market, it's painful when you're at 50,000, but they know like, hey, it's probably going to bounce back. It always does. Give it a couple of months. And there's just so much social media out there and so much noise noise in podcasting now that people get their hands on, that I feel like those things deliver differently than just good old TV that used to be out there.
You look at your phone. Oh, well, we're Dow 50,000. Oh, that's cool. And then you move on, you know.
And then the gold is quite the anomaly. Like gold goes up when markets are going down. So again, since COVID, everything seems backwards, but people are, in my opinion, I think because of geopolitical risk and low interest rates, people are moving to gold. Even though it doesn't pay an interest, it does have growth. So people are going there, I think, to have a little bit more safety. But I'm actually surprised about that, only because historically people went to gold when markets go down, and markets haven't been going down. So we're just in another transition in our stock market world where interest rates are down and people aren't running to bonds anymore, and people are just shifting gears. They're shifting gears and they're moving to like gold, and they're moving to annuities. Annuities are the largest alternative investment out there being sold right now, and so is gold. And 10 years ago, we had way less people caring about annuities and gold, even though people always love gold. But now it's by the droves and masses. The same thing with annuities. So as time changes, we just have to adapt with the changes, and then probably sprinkle a few of these things in. It doesn't mean get rid of all your bonds, but let's be smarter with what kind of bonds we get, because, you're not going to make as much as you used to based on old school bonds, right? And so we just want to be cautious and spread our wings and fly in retirement so we have more income.
You bring up a great point, because there's so many different alternatives. If you say, I want to buy a bond, well, there's a lot of different ways to get into bonds. So there's a lot of different ways to get into stocks and different risk levels and things like that. If somebody were to walk into your office and say, I hear all this about gold, Charisse, it looks good. I'd like to, maybe put 5 or 10% into gold. Then there's a lot of different ways to buy gold. You can buy a mutual fund. You can buy an ETF. You can buy gold that you hold in your hand. You can buy all different kinds of things. Is there a best way to buy gold?
There's a lot of ways. And I, in my workshops, used to tell people, when you have a portfolio, be diversified and make sure no more than 5% of your portfolio is in gold. Okay. Some people, I would say, okay, for you, based on what was going on in the household, I might say 10%. And then I would say, do not go buy gold with an IRA and let another vault hold your gold. When you get into RMD season, it is a real pain in the butt. You want to stay out of those types of gold situations. I like when you just have cash in the bank and you go right down to your pawn shop or jewelry store and they're selling you gold. Okay. But I also want you to shop their fees, because some people will charge you 12% in fees to sell your gold. Some will charge you, there's called spots, et cetera, 3 to 5%. So you need to shop where you're going to buy your gold. And your financial advisors, like us personally, we buy gold in exchange traded funds in our portfolio. So when gold is kicking up, we're going to sprinkle a little bit more gold in exchange traded funds. And then when gold's not doing so good, we're going to, have less or maybe none. That's the fastest and easiest way to get in and out of gold, especially if you have IRA money. So be very careful how you use your tax dollars. So IRA dollars, in my opinion, should be an exchange traded fund type of gold, right? Or miners if you're going to go alone and buy some individual things on your own. If you want gold in your safe, I love that idea. Take some cash out of your safe and go buy gold, right? Okay. And be careful with silver, because if you want to buy a lot of silver, you better have a big case and a big lockbox, because you got to hold a lot of that silver. So just knowing where to buy it, what to look for when it's being sold. And I'm a big fan of exchange traded funds because the costs are pennies on the dollar.
You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. There are things that are happening out there and things that change. I mean, 2 years ago, we weren't talking about this. 3 years ago, we weren't talking about this. Now we are, because things change, and you need to be in touch with your financial advisor. And we're going to talk about that a little bit later on in the show. To talk to Charisse and to ask those kind of questions, give her a call. It's 833-368-3680. 833-368-3680, or use the website, which is zinniawealth.com, ZINNIA wealth.com, and there's a gold box there. It says complimentary retirement consultation. Click on that, and that cues up that conversation to get your questions out on the table. Again, zinniawealth.com. All right, so I got a survey here in front of me about people who make financial mistakes. And it says Americans each year lose about $1,000 to financial mistakes. And about 10 million Americans make a mistake that costs them over $10,000. So, Sharice, I know that sometimes people come to you and say, hey, I need to start my retirement planning. Other times people come and say, Sharice, I got myself in a fix. Can you help me get me out? And what's some of the mistakes that you've seen that you've had to, kind of dig in and bail them out?
I've seen some really bad things.
Okay.
From scams to cashing out a full 401k to having too much risk and not having an advisor that knows what they're doing. And so let me talk to you about the one that's about risk first. So we had a family that came to us in 2010. So the crash already came, right? And their advisor that they had for 30 years and then retired them and still had the same advisor, had the same risk category in their portfolio. They never changed anything. Their $1.6 million dove down to $800,000. On top of that, the advisor said, hey, you can pull 6% a year for the rest of your life. 6% is way too high, number one. So while the stock market was crashing in 2007 and 8 for 18 months, they were pulling that 6% out annually. And when you crawled out of that elevator and walked up those stairs for the next 4 years to get back even, they were still pulling 6% out. So they never got back to even. And their accounts went even lower than $800,000. And so just big mistakes, not working with the advisor that is focused on retirement planning, safety, and growth. It was just more of a stock jock that they had worked with for years. Of course you trust them. You've been working with them for years. You just didn't work with them during this withdrawal phase of your life. And so a lot of people don't know that there is another season of life where you do need another seasoned advisor, and it's that retirement planner. So that was one of them. Oh my gosh. I have a client who's in the middle of a scam, and it's real bad. And she came to me and said, Sharice, I can't tell you this. I have to keep it a secret. I've been bearing this weight for months, but I feel like I got to tell somebody. And I'm like, oh dear. And she's like, I think I've been scammed to the tune of hundreds of thousands of dollars, you guys.
No.
So we're digging deep into it right now, getting OPD and some people involved. But she's so scared that she's going to get so in trouble with these people. And her husband passed away 2 years ago. So I wish I had an answer to how, when the spouse passes, especially a lot of these women, and there's men too, they fall short and they give this money away. And the financial advisor that they trust most, for some reason, they do it anyway. So these people, these scam artists are so good. It's so disheartening. It ticks me off. And if we could figure out that solution, boy, it would be amazing. So that's one that's going to cost this person a lot of money. And then the third one is taxes. When I first got into this business, I'm not going to say who it is or where they came from, but they went, yeah, I got $1 million and I took that 401k and I put it into my bank account. A year later, they came, I hadn't met them before, came in. It's like, yeah, I had to pay like over $300,000 in taxes. And I said, why didn't you roll your 401k to an IRA? He's like, I don't know. The advisor there, I didn't like him. So I just said, I'll just put it in my bank account. And then he got hit. It was just like, you saved $1 million. I know you're smart, but you didn't know that was happening. So it's just interesting. It's like little things. I think people get busier. They get excited and or they think that they can just do it on their own. And they don't think through the steps or just certain things like that. And this is why you really do need a financial advisor, especially as you're approaching retirement, to help you with those one-off mistakes that could save you hundreds of thousands of dollars.
It's one of the reasons you sit down with someone like Sharice to be able to bounce those kind of things off if something comes to mind, or you get one of those phone calls. You say, hey, Sharice, I got this. Does this sound like it's on the up and up? Maybe it isn't. And let's have somebody that you can bounce those ideas off that you can use as a resource. Sharice is here for you. ZinniaWealth.com is the website. ZINNIA wealth.com. Check that out today. Give her a call. Let's sit down and talk about your retirement. 833-368-3680. Again, 833-368-3680. I've mentioned for years, if you've listened to this show, I've talked about my mom, and my mom passed away back in October. And so we are now dealing with her estate. And it's not a big deal. You know, she was in a memory care unit, so the house had been sold and all sorts of things like that. But she had some insurance money. So my brother and I are going to get this money, and we're working with my mom's insurance company. So here's something that might happen to you. Your parent passes away. They have a financial advisor or a insurance person, and they're going to probably want to either keep some of that money or they're going to want to pitch you on managing your money. Well, this is what's happening to me right now. So I said to her, okay, fine, go ahead, pitch me, show me what you would do with this money. And I got all the paperwork back. One of the things that it said in there is, we promise to view your portfolio annually. And I go, really? You're going to look at my money once a year? That's what you're telling me? You're promising me that? You know, Cherise, the thought of that just kind of makes me a little bit angry that, you know, I would make a meeting at the end of the year to check on my money, and she would go in there 10 minutes before, take a look at it, prepare for the meeting, and then that would be the only time she looked at my money that whole year.
Randy,
I don't like that.
You know that's how it works in this industry.
Come on.
What are you expecting? Not everybody's going to be like me and Team Zinnia. I'm glad you did that so you could actually see what real life is like.
Cherise has a high bar that you got to jump over, girl. All right.
It is.
How often do you meet with clients? What are the circumstances that you would have to meet with them more? Tell me about that particular aspect of it.
Yeah. So, right now we're going through a couple of divorces. So I'm seeing spouses individually. And so I'm seeing them a lot. So that time of your life, when you go through times like that, we're there. We need to be there. We need to be making changes because there's a ton of changes. It's an emotional time period. We're seeing a lot of death right now. And so there are so many steps to when somebody passes away. I have a client who passed away, 6 months ago now. And the first month she was in here twice a week, just organizing papers, doing this and this, because her husband really did most of the stuff, even though he had been teeing her up and training her, and she came into all of the appointments. But when death happens, something else happens mentally because it's emotional, and then you kind of forget a lot of the things that you've been taught, and then things are missing. You're grieving, and so it was a really tough time. And then some other advisor, they had bought life insurance from an advisor in Gainesville, and the advisor, he was an insurance agent, and he's like, well, bring your statements from Zinnia and we'll move everything over to us. She was like, what are you talking about? I just want to cash out my life insurance policy.
Right.
And she's like, why would I move it to you? He's like, oh, well, we're going to be doing your life insurance. We might as well do the rest. Let us review your statements. He's like, you're an insurance agent. Why would I go to you? I was like, I've got an advisor. At least she had her wits about her to be like, yeah, who are you, crazy man? But that happens a lot because people think that they're not going to help you unless you bring over your assets. But our clients are trained very well and armed very well with language to know when somebody's really just doing that shamble thing, right? And so that is definitely a time period that we're seeing clients a lot. And we have our reviews. I really like face-to-face reviews. Not all the time can people do face-to-face reviews. So recently, I had a client come in, and then in 6 months, they need to come in for something else. So we scheduled a Zoom because I'm going to be out of town. But people just want to see you. They just want to know you're doing something. They want to see the math on the screen. Like we build these income plans and these tax plans. So when they come in, they're like, okay, here's my income plan. This is what I still have left over. Okay, great. We're basically growing our accounts, and they're still going up, and we're taking income out, right? And they just want to see that. And if they take a lot out more than ever planned, we're going to show that in the plan so that they can see it. So people just want confidence that you are doing something because they are paying these advisors fees. And there's no worse feeling than being charged a 1% fee and not really knowing if they're doing anything. You just hope they are. And hope is not a plan here at Zinnia. So we want you guys to be educated. We want you to see things, and we want it to be consistent.
And many times when we talk about these changes, we tend to dwell on the negative: divorce, death, job loss, all these different things like that. But there can be positive things that happen too. A new grandbaby may come along and you say, okay, I'd like to start a college fund here, a 529 or something like that. Or, the kids are getting big enough now. They're 7, they're 8 years old, my grandchildren. And I think it's time that we go to Disney World, or I think it's time that we take that cruise that we've always wanted to do. And can I do that? How can I do that? Where does that money come from? Those kind of occasions take place too.
They do. A lot of grandparents, they come in and they're like, I really want to do something for my 12-year-old grandchild, Susie. And I'm like, well, why don't you bring her in, or why don't you talk to Susie and ask her what her favorite toy is, her favorite drink is, and start talking to her about stocks and how to save money. And instead of you giving them $500 for a massive toy, why don't you invest it in a stock? And so there's different accounts you can set up for kids to do that. I had a installer the other day. She's been a client of mine for like 20 years. And she's like, I'm going to take my grandson to England this year. Nice. And so making sure those funds are there. So every year she takes another grandchild, like somewhere really special. Cool. And so, there's always a rhyme and a reason. And being able to shell out that money to be able to do those things is a really precious, wonderful thing.
It is really cool. I mean, it can go one way or the other, but the main thing here is, and I don't want to make it sound like, you're a 16-year-old and you have to go to your dad for $20 to go on a date. I don't want to have to go to my financial advisor and go, please, can I have this money so I can buy an RV? I don't. Yeah. But, big purchases like that, you need to sit down and talk through it. And I mean, a trip to England, that's going to be a pretty big price tag on that. And you got to sit down, and I don't necessarily, you made this money, you saved this money, you should use this money. But let's make sure it comes from the right place so it makes sense. And that sometimes, Charisse, is the conversation, isn't it?
Yeah, make sure it's coming from the right tax bucket. I mean, it's either going to come from the taxable bucket or the tax-free bucket or the tax-deferred bucket. And depending if you're rolling IRAs or Roth, or where your income's coming from, pension, Social Security, cash rents, it's going to actually make a difference on what buckets we pull from, and if we're going to use tax loss harvesting. But Randy, I will tell you, a lot of people who want to take grandkids on trips, they already convey that to us advisors when they come in saying, hey, I want to make sure I do these trips, and I want to make sure we put this into our income plan. So it's usually delivered and sealed up and ready to rock when they're ready to pull those dollars out. And if they don't do it, something comes up, they find a place to spend that money. So we just that's why we like to buffer up those income plans the first 10 years of retirement.
Yep. Make sure there's a line item there for that. And then the other thing that I think of, we got about a minute or so left here, is when something happens like the big, beautiful bill, and then there's a $6,000 deduction that you didn't have before. Those are also reasons when things change and laws change to come in and knock that around a little bit and say, how does this affect me? That's got to be another reason for a meeting.
Oh, yeah. Like right now, we have a lot of households getting a $12,000 credit because their husband and wife are taking Social Security. They're over 65. And they're just like, what do we do? We want to make sure we use every bit of it because they're not going to give us a refund if we don't. So does that mean we should roll more IRAs to Roth? So we're talking to a lot of people about doing that, making sure we're using every dollar because it's free money. And if you don't use it, you lose it. So it's important to have those conversations. And, people, when they first come in, they're not turning on Social Security right now. There's a plan to turn it on later most of the time. And when they come in for, it just happened recently, we weren't supposed to collect Social Security for 4 more years with one of my clients. And we re-looked at my math and we re-looked at how much everything's been growing. And then we looked at his health and his wife's health. And you know what? We ended up turning it on. So things change in people's lives. It could be health. It could be family. All of a sudden, kids are living with you again, or you adopted a grandchild, right? And or you're like, I want to just really travel a lot. Give me that Social Security check. There's no wrong and there's no right. It's what's right for you. And the goal is, let's just not run out of money while we're trying to do this. And let's try to make sure we have some money for long-term care. So we're not standing at the front door of our kids' houses with our hats in our hands saying, I need you to take care of me. So we want to make sure all those avenues are covered.
You're listening to Retirement Coffee Talk with Charisse Rivers. To sit down and have that resource to bring Charisse into your life to help out with your retirement and those decisions and all that comes along the way, give her a call. 833-368-3680. Again, 833-368-3680, or use our website, which is ZinniaWealth.com. Well, apparently I have stumbled upon one of Sharice's great weaknesses of the world, and that is Oreo cookies. You don't buy Oreo cookies because you can't control yourself. Is that right?
I can't. The same reason why I don't buy Girl Scout cookies. Oreos and Girl Scout cookies are never allowed in my house because every cookie will be gone the second it lands in my kitchen. I have some weaknesses. It's a good thing it ain't alcohol and drugs. I stay away from that. But boy, oh boy, you'll see me pick out on some cookies every once in a while.
Okay, so what? So is there a cookie that you can buy that you can only eat like 3 or 4, and because an Oreo cookie you just slaughter
like
the whole
Fig
package?
Newtons. Fig Newtons.
All right. Those you can only do just a couple, huh?
Yeah,
okay.
and so if I had a bag of Oreos and a bag of Chips Ahoy, you know, there's 2 things in Chips Ahoys and then there's 3 lanes in the Oreos. So I could just eat 1 lane of Chips Ahoys and leave the other one there. But if I had the Oreo, I mean, you guys won't believe this. I mean, my cheeks are a little
the whole
chunkier.
thing out?
Because you dip it in the milk and it's like, it's soft. Literally. I know. I've tried to train myself just to break the cookie, eat one piece at a time, and eat the cream inside. But I have zero patience for that.
Okay. All right. So I have really, really bad news for you. Okay. There's a high school math class in New York, and they decided for their project, they were going to see if you took a double stuffed Oreo and a regular Oreo, is the double stuffed Oreo exactly or more twice as much cream as the single Oreo, right? Okay. It's a double stuffed. It should have double the cream.
Yeah.
The answer is no. The answer is no, my friends. There are 7% short of the cream in the double. It's fake news. I am so sorry to disappoint you.
That is not true. That's not true. You know why? Because I don't buy double stuffed Oreos because I don't like all the cream. I could tell there's a difference. Those kids failed that lab, or the teacher let it go by, or they just wanted to advertise and market how smart they were.
Math, Sharice. You can't go against
I'm going to have to investigate this.
All right. Okay. She's going to do her own research, so she's going to be plumpy by the next show.
I'm actually going to go to Facebook, and I'm going to show the viewers regular Oreo, and then I won't eat them all in front of you, but I'm going to tell you, I don't believe it to be true.
All right. All right.
Maybe so. We'll see.
Why am I talking about this?
I know. Why are you talking about this?
This is Randy the Master spinning it into retirement. Okay. So there are things in retirement that aren't exactly what they seem. Just like the double stuffed Oreo isn't exactly what it seems. There are things in retirement that aren't exactly what they seem. For instance, all these years you've been saving in that 401k, and you look at that number and it's a really good number. Except it's not all yours. That's one of the fallacies of
good
this.
Point.
It's not as good as what do you see, Sharice? I mean, if somebody had $1 million in their 401k, all right, how much of that is actually theirs?
You know what? When you come in and do your tax plan, I'll show it to you. I'll show you your $1 million in retirement accounts and your income, and we'll show you taking your RMDs that you're required to take out at age 73. It never stops until you pass away, and then it passes on to somebody else.
Right.
And what you're going to see is we see an average of $300,000 to $400,000 in taxes.
Yep.
So if you have $1 million, and let's say it's $350,000, that $1 million is not going to your beneficiaries, right? $650,000 is likely, without doing the exact math on radio here, going to your beneficiary. So it's not what it seems. So you're 1,000% right. And it's gotten worse because your beneficiaries, after the second spouse passes, used to be able to stretch that IRA for their lives and take a little percentage out. They'd have to pay an entire tax bill, and you could even send it off to the next generation's life. But now those rules don't apply, and you have to cash them out over 10 years. So it's a big tax whammy, and it's bigger than ever. So that is definitely a little deceiving if you thought your $1 million was being passed on 100%.
When you do your math, and we always say that on this show every single week, do the math on your retirement. If you did a systematic withdrawal as opposed to taking that $1 million IRA and then paying the $300,000, what does that do to the tax bill by spreading that out? Are you paying less, or is it you're just taking a little bit of the pain a little bit at a time? What is the difference there in the math?
So basically what you're saying, if we have $1 million and we just cashed it out and put it in the bank account, right? And or put it in a brokerage account and pay the taxes now and then let it invest. The taxes are kind of similar, by the way. It depends on a few elements, but it's where you invest the money afterwards that makes a world of difference.
Okay.
So if you cash your money out and say, I'm going to pay the taxes now and put it in a brokerage account, taxes will be there forever. Every time you cash something out, you got to pay taxes. If there's a dividend, you got to pay taxes. But if you cashed it all out and put it into a Roth IRA, your estate will be way higher by hundreds of thousands to millions of dollars. So it's okay to cash these out. I like to cash them out over time, like over 10 years. So if you're trying to get into a tax-free zone for you and possibly your spouse and then pass it on tax-free to your kiddos, I like to spread it out a little bit depending on if you've collected Social Security now or if you're going to collect Social Security later. So there's so many moving parts that go into it. But when we do our tax planning software, Randy, on one hand, you're going to see, what if I do nothing over the next 30 years? And on the other hand, you're going to see, what if we did a rollover of $50,000 a year for 10 years or $100,000 a year for 5 years or 10 years? What does it look like? And the taxes are almost identical. I would say 8 out of 10 times, but the legacy being passed on to the beneficiaries and the surviving spouse is astronomically higher, which is brain-boggling to me that I did not know years ago until I started working on this software. So their CPAs don't have the software. There's another advisor in town that has this software. It's very expensive to use, and so most people won't use it. But I will tell you, my CPAs are like, send that over to me. That's great stuff, right? Because I want to see it, because even CPAs don't understand. Some CPAs you go to, I know I'm going left field, everybody, but some CPAs you go to, they're going to say, don't roll your IRAs to Roth because they don't understand financial planning. It blows my mind. And then the other half of the CPA is like, yeah, roll your IRAs over to Roth. So why there's this educational break in between what CPAs know and don't know, or if it's just laziness, blows my mind. But we will not work with CPAs unless they truly believe in a Roth.
You're listening to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth, and we're talking about things in retirement that look a lot better than what they actually are. One of the things is your 401k. Not all that money is yours. Another thing might be somebody might, go in and say, well, what am I going to get for Social Security? And they find out, oh, this looks pretty good. I'm going to get $3,500 a month. That's a good Social Security payment, twice as much as what a lot of people are getting. But the fact of the matter is it might not be $3,500 a month. They're talking about cutting that back by 20% in a few years. There's also the idea that if you make too much income, that $3,500 could get taxed. And a lot of people don't realize that, do they, Sharice?
Yeah, there's a secret little thing out there you'll figure out one day called provisional income formula. It's how we figure out how much of your Social Security is going to be taxed. And up to 8% of your Social Security is taxable. By the way, if your income, you're married filing jointly and your modified adjusted gross income is over $44,000, which is so easy if you got 2 Social Security checks, you got a pension check, you got some RMDs. A lot of people are hitting that up to 85%, right?
Yeah.
And so when we do our workshops, we show the math. Here's your federal taxes. Here's your state taxes if you live in a state that charges those state taxes. Here's your Social Security taxes. And here is, if we put a tax plan together, and we can get you from this up to 85% taxable Social Security amount to 50%, boy, we can show you how to really lower your tax bill by just hunkering down, doing some tax planning now so that the remaining 20 years of your life or your surviving spouse's life is a little bit more comfortable in the tax world.
There's so many things that as we look at those numbers in retirement that they might not be exactly what they seem. And the best thing to do is to have a heads up on that before you get hit with a big tax bill and that you didn't expect, all those different things like that. Give Sharice a call. Let's give you a heads up on the future. And if there's something out there in the future that we need to head off, let's start planning for that right now. 833-368-3680. Again, 833-368-3680 or online at zinniawealth.com. There's a gold box there. It says complimentary retirement consultation. That's a big phrase for a free meeting. So let's sit down and talk through your retirement. All right. So I don't know how you feel about Elon Musk. And I mean, you got to admire him in some ways.
He's interesting. He's smart.
He is a pretty interesting guy. Well, he had a quote this past week about retirement. And I thought, this is kind of out there. This is kind of crazy. He's basically saying here that AI and the advancements that we're going to have in technology are going to make it so we don't have to save for retirement anymore. Take a listen.
Well, one side recommendation I have is don't worry about squirreling money away for retirement in 10 or 20 years. It won't matter. You won't need to save for retirement. If any of the things that we've said are true, saving for retirement will be irrelevant.
Services will be there to support you. You'll have the home, you'll have the healthcare, you'll have the entertainment.
The way this unfolds is fundamentally impossible to predict because of self-improvement of the AI and the accelerating timeline.
All right, everybody, just relax.
Holy cow. Holy moly. The millennials are like, yeah. That is insanity to me. I'm not going to say never is never and maybe can never. It can't happen.
Wow.
How in the world does that even happen?
See, I see this going completely the other way. He says that technology is going to make it so that we don't have to plan for retirement and everything's going to be there, which is a little socialistic. But anyway, we'll get onto that later.
You know what? If that is a true statement, Randy, that means we no longer control our universe and artificial intelligence controls our universe. Therefore, artificial intelligence paying for retirement, it owns us now.
Yeah.
You hear that?
It's the Terminator.
I'm going to dig into this.
I'm telling you. Now, here's the way I feel about it.
Okay.
I don't see it going that way because pensions are going away, which means we have to save more. Everything's more expensive, which means we have to save more. Government programs are falling apart, which means we have to save more. It seems to me like it's getting more on us than it is on anything else than what he's saying.
Well, and our debt's higher than ever.
Yeah.
What are we going to claim bankruptcy as the United States, right? I mean, I guess Trump's good at that. And then Bitcoin runs the show. And
that's been cut in half, yeah.
And then, and the robo-bots and AI is working for us, so we can just go sailing in the sunset at 40 years old. All right, you guys, there's a lot of noise out there. I don't want to dig too much in the weeds because this sounds absolutely, I'm going to say it, retarded.
It sounds pretty crazy.
I don't say words like that, but it's pretty retarded. Check back with me in about 10 years. And, Elon has been known to say some crazy stuff, by the way. That is not true. That doesn't come to fruition. But I like his tenacious, futuristic thoughts because how fabulous would that be? Everybody would probably live a joyful retirement, right?
And Charisse is out of a job.
Total out of a job. I'll have to figure out a quick retirement plan.
All right. You're listening to Retirement Coffee Talk with Charisse Rivers. Right now, folks, it's all in our hands. So we've got to step up and do it. So let's do it. Give Charisse a call. Give her a look on the website. And let's have a conversation about your retirement as soon as possible. Let's get something down on paper. ZinniaWealth.com is the website. Again, ZINNIA wealth.com or 833-368-3680. 833-368-3680. All right, so MoneyWise did an article about things that can derail your retirement. And I said, well, this is going to be the same old stuff. And it was markets, taxes, and long-term care. But they also pointed to something that I've never heard about before, and that is what they refer to as slow leak spending habits. It said most retirees don't spend their wealth on yachts or luxury watches. Instead, they gradually lose it through uninteresting and often overlooked expenses. So what little habits have you seen that have kind of got into the retirement nest egg that you go, maybe you should slow down on this? What do you see?
Coincidentally, in the last month, I've done a few reviews, and there was a young couple. They're not retiring for another 5 years, and they were telling me about their Amazon purchases. And she's like, oh my gosh, you should see all the Amazon boxes that come in that he's purchasing. And he's like, what are you talking about? Half of those boxes are yours. So I see husband and wives going, we buy everything through Amazon nowadays, right?
It's so convenient.
And it's so convenient, but you have to understand it's convenient. But some of those things you're buying, like if it's laundry detergent or toothpaste, some of them are like a third more in the price and people aren't paying attention because some of the stuff you see is, this is a good deal. And you put it on autopilot and it just shows up every month. Hello, that's a leak for sure. And then I don't know, it might have been before Christmas. Husband and wife came in and the husband said, I know you said she could spend more money in retirement. But did you mean on QVC? Because she buys stuff on QVC all the time. I'm like, listen, she's got her own budget. If she decides to put it in QVC, she can. But, it's, little small leaks that spend more money because they're starting to see it. They're like, okay, we have all this money and now we're taking some of these checks. The younger couple is not, but this older couple is. And he's like, my wife's money is disappearing and I'm not seeing any of it. And it's the QVC that's going out. And I said, everybody has their wish list.
I think that when you're in retirement, I get it. You got extra time. So you're sitting there watching TV or you're watching, you're online and you're going, oh, look at that, and away you go. But I think that you should be able to do stuff like that or just make sure you're doing it sensibly. What gets me is I know you love Susie Orman for some things, but Susie is one who shakes her finger at us and says, you shouldn't go to Starbucks and, you and your $4 coffee and you shouldn't go out to eat $4.
It's like $8.
Well, you know me, I don't drink coffee. My wife does, though. I think I've almost got her order down. And, 2 pumps of the sugar and a certain amount of, I can't even do it anymore.
You should have this right by now. But
I should have this right. I should be able to do this.
Susie Orman, she does tell people, no, you're denied or you shouldn't be doing that. And she is retired. She should know better by now. She should be saying, hey, live your life, right? Yeah. Especially as you retire. Doesn't change her tune, though, and I'm not really sure why. So we don't want to listen to everybody, all these big talking heads that you hear. There's some great information she pulls together, but not all things are true or what they seem to be. So
I think they can give financial advisors and advice a bad name because I don't think, as I said before, I don't think people want to feel like they turn their money over to a financial advisor and then I have to ask to get my money like I'm a teenager. That is not supposed to be the relationship between you and your financial advisor.
No. And it's funny. Every client always asks me, why are you okay with me keeping so much money in cash, Charisse? I'm like, because you're about to go spend it. And I don't need you to ask me every time you need to buy something. I said, your money's still in that cash account. It's going to make 4%. You know what is interesting since we're talking about Susie Orman? Dave Ramsey the other day said, somebody called in and he's like, yeah, spend your money. I was like, oh. Something Dave said that I agreed with. I'm like, he's like, spend your money while you're healthy. So it's funny how you have one talking head that says no, and you have the other talking head that says yes, right? And it's interesting taking a little bit of information from all of them. But we do believe you should spend some of your money. We do believe you need to be cautious about how you spend your money. But where Susie Orman is right is if you don't have an income plan and you can't see the next 20 years of your life, then maybe you shouldn't spend your money so you don't run out because you can't even see what the future possibly looks like. So let's use some of Susie Orman's information, dial it in here at Zinnia. Let us build your income plans, your tax plans, and then let's go over to Dave Ramsey and say, now let's spend some money. And let me show you how to do that in our income plan because you've worked your whole entire life to do this. So now it's time to do this and not be scared to do it.
If your biggest fear is running out of money, and that's what everybody says, that they no matter how much money they have, everybody's afraid of running out of money. If you had a spending plan, and this is not a budget, if you have a spending plan to know that you could spend this amount of money and not have to have that worry, that gives you a little bit of confidence moving into this time of your life. Give Charisse a call. Let's put that down on paper. 833-368-3680. 833-368-3680, or the website is zinniawealth.com, ZINNIA wealth.com, and hit that gold box. You'll be on your way. All right, so we have talked about this phrase a number of times over the last couple of years called FOMO, FOMO, which stands for fear of missing out.
I have that problem.
Oh, yeah, I know you do. We have the market going up, and then people want to get in and get a part of that, and then they get themselves too far out on the risk scale. Then the market goes down, and then they get hammered.
Yeah.
Well, there are some new acronyms out there. This one is YOLO, YOLO, which means you only live once.
I like that one. That should be a retirement one.
Yeah. And that is people spend a lot of money. They feel I'm not going to live that long, so I'm just going for it. And there is a problem there, too. And then there's another one now called JOMO, which is the joy of missing out. And people just going, you know what? Y'all just go do what you want to do. You go do your risk in the stock market. I'm going to do my 2 and 3%. I'll be just fine right over here. So I imagine you have people that are all over the scale when people come in and how they're going to use the stock market and how they're going to spend their money.
A client literally just came in and I was like, what are you guys doing for travel this year? And she's like, I want to go on cruises. He's like, I want nothing to do with cruises. And he's like, you go on your cruise and I'll stay home. And I'm like, now he's having the joy of missing out because he's okay with it, right?
I think what this whole thing is people don't know how to use the stock market. They're either all in and they're like that person who's like, you know, I'm just gonna go for it and I'm gonna spend this money, or they're so scared that money's gonna be taken away from them and they are gonna run out of money. And that's really what this all boils down to here is a conversation about risk.
So let's talk about FOMO then, because I can't tell you how many times, and it happens so many times at the wrong time. People have FOMO. They hear about the stock market growing. They're still sitting in CDs. It's sitting there making 3 or 4%. And then all of a sudden, somebody who's very conservative all of a sudden is like, well, my neighbor Bubba's doing it. I just need to do it. And then they jump in. It's usually the wrong person. They jump into the stock market and they chase this tail of the rocket ship because that's what everybody else is doing. And they just happen to always do it at the wrong time. And eventually they get burned. And then when they get burned, that means they just took a loss that might have only been 10%. Maybe it's 20%. And that ultra conservative person, guess what? They sell at that 10% loss or 20% loss and they can't control their emotions. So there are these FOMO moments for very conservative people. But then there's also FOMO moments for people who are moderately risky and they have just enough at risk. But then all of a sudden, they feel like, oh, I need to make more money. Like we start to get greedy. And then they want to make more and more. And then they take more risk. And then they get hits. And they're like, dang it. And then next thing you know, they're pacing up and down the hallway at 2 o'clock in the morning saying, shoulda, coulda, woulda. What were we thinking? And so this is why in retirement, you have to have a balanced approach. We can have the Amazons and the Elon Musks and the Teslas of the world and a little bit of our portfolio over here. And then we can have our dividend portfolio. Dividend portfolios still lose up to 30%, some more, some less. But at least we get a dividend more times than not. And then we have our 60-40 or 40-60 portfolio that does a reasonable average. And we have that 40% in bonds because we want some safety, but those can still take a dive of 30% or more. And then we have our safe money strategies where you have 0 losses. And so those are the indexing strategies with the insurance companies. Those are your CDs. Those are your money markets. Those are some of your notes. So sprinkling a little bit of all of it in so that when the knife drops and the stock market crashes, you can say, okay, I'm going to control my emotions. I'm not selling my Tesla or my Amazon, even though it dropped 50% because I still have income over here in my safe money strategies. So if you're diversified and you have a plan for that, you are going to control your emotions. You're not going to make wrong or bad decisions in retirement, wondering where your next paycheck is going to come from because you had that conversation with your financial advisor, right?
Yep.
You got to have a good team that understands this, that can explain it to you.
Yeah. For those of you who had FOMO on Bitcoin, take a look at it right now. It's went down 50%. Yeah. All right. You're listening to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth as we kind of wrap things up today. Hey, if it's time to talk about your retirement, let's get that conversation going. It's just a phone call and it's a no cost, no obligation meeting. Get your questions out on the table and see if you and Sharice are a good match. It's 833-368-3680. 833-368-3680. Or the website is zinniawealth.com. Sharice, that's all the time we have on this one. I'll give you the last word.
All right. We appreciate you and your listenership and all the questions that you send in to us. Keep sending us questions. We will answer them on air. And as usual, live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC. a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.